Let's look at what the market is doing. Imagine the market as a football field. They're about to play a match. So we have two teams. One side of the team are buyers. The other side of the team are sellers. What will happen? Will buyers allow sellers to overpower them? No. Will sellers allow buyers to overpower them? No. That's the truth. That is just the truth. But what is going to happen is that at time one player will move the ball. Pay attention to this part. This is the interesting part. Sometime one part of the team will move the ball closer, move the ball forward, not to score immediately, because the opponent side has a strong defenders. They want to pull the opponent out from their defense. By the time they are able to pull the opponent out of their defense, they can now sell the ball in and find an advantage to score. I want you to understand this like this. I like my training to be very simple, and even if you're a 7-year-old child, you can hit the ground running. Yeah, you can hit the ground running. You can understand what we are talking about. So I want you to imagine that this player A wants to sell, but player B is defending his own territory. Player B also wants to buy, but player A is defending his territory. One of them wants to sell in advantage. The seller wants to sell when the price is high. The buyer wants to buy when the price is cheap. So what are they going to do? Pay attention to this part. What they are going to do is that they are going to trick or dribble, anyhow you're going to put it. They are going to dribble their opponents. So at a point, they are going to move the ball in to the opponent side, so the opponent will come out to attack. While the opponent is coming out to attack, they will take advantage to score. This is the same thing that happens in trading every day. It happens today. I'll show you this on the chart. On the trade I took today on BTC USD, I'll show you this. Even on XAU USD, I'll show you this. That is it. So this is what price does. These three things, it does it every day. The first one, price is going to move. It's going to post. It's going to trap traders. Please write those three things down. Price is going to do this. It's going to move the trade, post, and trap. Look at this image. Good. Now at this point, price move the trade up, move it down. It paused, move it up again, and pause, move it down. Now at this point, the price has formed double top. It becomes a resistance. Remember, I taught you guys resistance on the foundation training. Now it becomes a resistance. Price came back to that resistance and respect that resistance. It now becomes triple top and go back again. Since the price has respected this resistance and reverses, when the price come back here, what do you think people will do? Now, by the way, at this point, a lot of stop loss are above here. So the price have been able to trap a lot of traders into the market in this resistance level. A lot of sellers are going to enter the market. Then the price will now move to the third level. What is that? It's going to move to what we call liquidity. Now, there's something also you need to understand. When price pause in a certain area like this, price pause in a certain area like this, the price is forming an order block. That is where big institutions step into the market. That's where big institution places their trade. So big institution will enter the market and place their trade in an order block. You need to understand this. So price will move, it will pause and move again, and pause again, and move again, and pause again, and move until their order is filled before they move on. That's the first thing. Now, another thing you need to understand is liquidity. Look at it this way. Now, by the time price have been able to pause between this area, when price move above or below an obvious level, I use the word here obvious level over a repeated period of time, this obvious level becomes a trap. It becomes a trap because a lot of stop loss are going to be mounted at this point around the world every day, in Nigeria, in Ghana, in Senegal, in America. A lot of people are going to put their stop loss here, and you know what they're going to do? They're going to trigger the stop loss. All the stop losses, they're going to trigger it. and move their market upward. And once they trigger it, all the people that you've put in their stop loss here are going to run losses because their stop losses have been haunted. Now, we also have breaker traders. By the time their trade have been hit stop loss and they lose money, a lot of them will begin buying, thinking, okay, the market has break this resistance. Since it has break this resistance, the market want to buy. They will start buying. As they start buying, the market will eventually reverse and hit their stop loss again. Those things that happen in that place is known as liquidity grabs. Those things that happens within this axis, whether it was a stop loss of a sales or a stop loss of a buy, is known as liquidity. The institution need that before an impulsive move happen. Please, you need to understand this. You're about to become a profitable trader, so you need to start thinking like the professionals, no longer like a gambler. Yes, so you need to understand that they must grab liquidity at the resistance level. At the foundation level, I didn't teach us liquidity because the concept was far higher than a mere amateur to understand. So that is why if someone wants to become a profitable trader, he must move over to the advanced training. Yes, because if I say I should teach all these things, a newbie will become confused. A newbie, now that I've just mentioned resistance level, it is easier for you to understand resistance. And I've talked about resistance, I've moved on. I've talked about liquidity today, I've moved on. Mind you, when I was teaching support and resistance, I took a whole day to explain support and resistance, a whole day, so that you can understand. But because you have the knowledge of a resistance level, it is easier for me to talk about resistance here, and you can easily see the resistance. Then move to liquidity. So now what you're learning today is stop loss and liquidity. You have already known what is resistance level. Did you see the point from that angle? So that's why an amateur might be confused if I put everything together. And that is why before you can adhere to the advanced training, you are expected to finish the foundation level. The foundation level prepares you, put you in a good phase for you to accept, for you to embrace, for you to understand, for you to be able to digest the solid food as some matured people. Yes. So in simple terms, candlesticks shows fear in the market. It shows emotion in the market. Then order block shows institutional footprint. Order block shows institutional footprint. Please write these three things down. Candlesticks is showing fear, that's emotion in the market. Order block is showing institutional footprint. Liquidity graph is showing areas in the chart where traders are being trapped. Just like you can see here. At this particular point, traders were trapped at this point. Both buyers and sellers were trapped at this very point. These three things you need to understand, because these are the three things that we're going to cover today in this training. And believe you me, if you can understand these three things, you are launching out to becoming a profitable trader without any exaggeration. I'm going to show you how this plays out every day in the market. Now, the big question is, why does price move? Retail traders think that price simply moves because indicator says move or because chart pattern says move. But that's not true. No, that's not true. That's not why trade moves. Trade moves simply because there's an order of execution. When they execute a trade moves. That's the reason. It's not just moving because there's a chart pattern. For example, follow me through and look at this chart pattern. Now, if you look at this place from this point down here, this is a W, what we know as a double bottom. Good. Follow me again and follow me from this part. From here, another one from here to here again is a W. Then after this W, it was an impulsive move. So we have got two W there. Now, what is W? What is a double bottom? A double bottom is a bullish chart pattern. A double bottom is a bullish chart pattern. So now, the institution will create a fake double bottom. Look at it here. They will make the fake double bottom. closer to the real double bottom. So at this point, watch what is going to happen here. At this point, a lot of people will enter a buy order in this area. A lot of people will enter a buy order, placing buy, because they have seen a bullish chart pattern. So they will start buying. The price move this way. So everybody will be buying, putting their stop loss below here. Did you see now? Good. Once that has happened, institution will step in to grab liquidity, because institution need liquidity for their market to move, to enter the trade. They need a good liquidity to enter the trade. So they have to create liquidity for themselves. And that is the fake double bottom. This one you're seeing is a double bottom, but it's a fake one. Yes, it's a double bottom, but it was a fake double bottom. How do we know it was a fake double bottom? Because one, it happened not in a right place. This is the previous order block. For him to happen in this place is fake. That's the first thing. So the price will definitely sweep below this one. And that is why when it created this double bottom you're seeing here, it came up here, it swept down liquidity and went up, come back here before the main impulsive move went on. So someone could ask me, why did this happen? Isn't this unfair? Well, let me start with this. There is nothing fair in this life. Nothing that is fair in this life. Now, you're asking me, isn't this unfair? It's like asking me, why do players dribble fellow players? They're supposed to release the ball to their opponents. Does that make sense in your head? Of course, it does not make sense. Now, remember I talked about this earlier, that the market is a battle between buyers and sellers, team buyers and team sellers. So, team buyers want to buy when the team sellers want to sell when the prices is high. That is it. So, for that reason, one of them will always dribble the other. So, do not look for anything that is fair. If you're looking for anything that is fair, leave this industry. It's not fair. Yes, it's not fair. The institution would never accept it. Rather, they will always make it unfair. So then what do you need to do? You need to learn the unfair game and learn how to use the unfair advantage for yourself. Now, let me show you something. For example, look at this. Let's assume that the institution, a bank want to buy GBP USD worth $500 million. They will not just enter the market boom at once. Instead of them entering the market boom at once to buy at this point, look at this particular place. They might place order of $100 million at this area. See this area? $100 million. So that means this 500 million, they're going to divide it into 5 and go up. And once it moves us to this point, a seller that was looking for a way to sell will sell. The price will come down. Will come to this point. Now, they need the price to be very cheap so that they can have enough liquidity, enough profit in the market. So they will now create this fake liquidity you're seeing here for themselves. So that pay attention to what I want to say. A lot of buyers will put their stop loss here. By the time they sweep this place, a lot of sellers will start selling at this place. A lot of sellers will start selling, thinking that they are selling. So then they can now buy it at a cheaper rate here. Did you see what has happened now? They buy it at a cheaper rate at this particular area. They buy it here and move up. That is it. Now, would they just go straight? No. They will give an opportunity for other smart traders to enter. So once they place, at this point, they might place another 100,000 or another 100 million and create a fair value gap within this place. If you move down to 15 minutes or 5 minutes, you're going to see a fair value gap in this area. And the price will come back here and they can now fill the remaining maybe $200 $200 million, or the remaining 300, and the price will now move boom. That is it. So they must buy at a cheaper rate. That's just nothing but the truth. This is what happened. I know at this time you might be wondering, what does the institution do? Let me give you the answer to it. This is what they do, because they want to buy the price cheap and sell it high. They are going to push the price to areas where retail traders put their stop loss. Yes, I've explained this part already. You know, they have created price at this point. They have created a support, a fake support at this point. I've taught you guys support already, so you should understand that. Once they create a fake support at this point, they push price below this point. This is below equal low. So they're going to push price above equal high or below equal low, above resistance or above support or below support. That's what institution will do. Once they push price like that, now it's going to trigger stop losses. Once those people stop losses, all the stop losses that were in this area, in this place, all the stop losses that were within this place is going to boom and kick out of it. They now have cheaper rate. They are now have enough liquidity to use and move their trade, because at this point their price is going to be cheaper. People are going to sell, other people are going to sell randomly, and they're going to make more profits. That's what they do. Yes. So at the moment this is being done, a big move now, step into the market and move forward. I don't know if you have ever experienced this. If you have ever experienced this, go to the comment section and type, yes, I have experienced it. That you enter a buy, you've seen the chart and finish. You spend time analyze the chart and finish. After analyzing the chart, you see, oh, this is the right setup. You enter. As soon as you enter, immediately price goes below you and kick you out of the market. As soon as it kicks you out of the market, now reverse and go in your direction. And some people say it's village people. And like I said, there's no village people that is against you. Village people cannot control the chart. It is institution that plays the game with you. Yes, take it or leave it. The institution are playing the game with you. It's not bad luck. It is called liquidity engineering. Just like a player would dribble a fellow partner or would dribble his opponent in match, institutions are actually dribbling you. So what should you do? What you need to do at this point is you learn. You learn what the market is doing. Understand the game and play the game alongside with them. No logic. That's all. There's nothing else. Just learn the game, understand it, play the game alongside with them. Whatever come out of it, let's play the game. That is it. That's just it. It is known as liquidity engineering. I'm going to give you 5 steps, 5 framework that is going to guide you step by step to becoming a profitable trader.